Good Monday morning and welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director here at the California MBA. This month we're talking about capital markets, secondary markets, and investor issues. And we've got a great, we've actually got two guests today. It's a little bit of a bonus episode of Connect today. We've got two great guests and we're going to get into the conversation with them here in just 1 second. But before we do that, let's thank our sponsors over at Accelerate. So if you're looking to close out more loans in 2021, you need to check out and experience Accelerate's award-winning customer engagement platform that features lead management, CRM, call routing, sales enablement, marketing automation, borrower engagement, and data intelligence through innovative use of multi-channel marketing. And that's text, social media, email, direct mail, phone, ringless voicemail, retargeting, and much, much more. And as we always say, again, make sure to follow Josh Friend on social media, particularly on LinkedIn. He's got a lot of great content they're pushing out all the time there. And so it certainly behooves you to, if you're wanting to make sure that you're in the know on what's going on in that sector of the industry, make sure and follow Josh on LinkedIn. And if you want to make sure and get a personalized demo of Accelerate, you can go to accelerate.com right now and schedule that yourself. All right. Before we jump into the conversation here, I just have a couple of quick announcements from the California MBA. A quick reminder about our Mortgage Innovators site. It's brand new. We just launched it at the Innovators Conference a few weeks ago. We've got well over 100 blog posts. We've got tons of white papers, ebooks, and a lot of great content we're adding there on a daily and weekly basis. So if you're in the industry, if you're wanting to know what's going on in any of the life cycles of the loan, any from origination to acquisition to servicing, capital markets, and beyond, make sure go to mortgageinnovators.com, bookmark the site there. We've got a lot of great stuff coming out. We actually have a new podcast we're going to be releasing here in very soon, and so make sure and check that out. And again, one other thing I want to mention is that our Western Secondary Market Conference, which is coming up here August 24th through the 26th, in person again in Dana Point, California. We're going to be opening up registration tomorrow. On Tuesday, the 15th, we'll be opening up registration for the in-person Western Secondary Market Conference. So make sure and go to westernsecondary.com and you can register for the conference there. You'll have the early bird rate discount available for the first 30 days. So make sure and do that again tomorrow. Registration will open for the Western Secondary. All right, let's jump into the conversation. I'm excited to welcome in our two guests today. Mike McCully is partner with New View Advisors, and Jeff Birdsell is VP of Loan Programs at ReverseVision. Welcome, gentlemen.
Thank you.
Yeah, well, let's jump right into the conversation here. First, let's tell us about your backgrounds. For those who aren't familiar with you, what got you interested in the industry? What led you to where you're at today? How'd you end up in the space you're in instead of the more the traditional forward mortgage space?
Well, as most of us did, I started out in the forward business. I have been in the securitization business since the 1980s. And in the 1990s at Lehman Brothers was part of an in-house department that was helping to vertically integrate the firm's mortgage business. Lehman had just securitized then, this was 1999, the first non-agency private reverse mortgage securitization that we did for a company that Jeff worked for at the time, which is how he and I know each other back in the 1900s, as I like to say.
A while back.
Yeah, and so because we were looking to expand our mortgage footprint, the opportunity was there for us to acquire, in the end, 3 different companies, which we did and put together in 2000, the largest reverse mortgage servicer and originator in the country, which with about a 65% market share, called Financial Freedom Senior Funding Corp. And I managed that company for 4 years until Lehman Brothers decided to sell it. So during that time, we owned the company. We saw the HECM volume grow 8-fold to still a relatively small number, but $3.5 billion. And we grew the non-agency business to, again, a high water mark for us at the time, $100 million a month. So that was really my foray into the business, and I've been in it ever since.
Yeah. How about you, Jeff?
Yeah, so I was actually first introduced to the reverse mortgage industry back in 1992. I was with the company that actually started Financial Freedom, again, which is how I met Mike. Since then, I've worked with lenders and with a number of software companies that developing applications to present, originate, and close reverse mortgages. Also been involved with the creation of some of the private loan programs and pricing of those. From an involvement in the industry standpoint, I was one of the original board members in the Reverse Mortgage Trade Association back in the late 90s. And actually with the MBA, I became a certified mortgage banker back in 2006. So, once I got in, I fell in love with the industry and the benefit that it provides to seniors. So I've been stuck in it and loving it ever since. So that's kind of my background.
Well, in between getting your CMB and being on the board at the National Reverse Mortgage Lenders, I mean, you talk about you dove in, head first.
Really?
Sounds like
all in.
Yeah, you're definitely all in. Yeah. So, well, let's we've got two guys here that are certainly as plugged into the reverse side of the industry as you could possibly get. So, tell us just particularly from the investor perspective, how do reverse mortgages differ from traditional mortgage loans?
Well, first and foremost, and I think most people know this by now, reverse mortgages do not require principal or interest payments. So all interest, servicing, any future line of credit draws, and any other advances are added to the loan balance. Borrowers typically certainly for the government product, need to be 62 years of age or older. They need to maintain their property, and they need to have that property as their primary residence. Loans mature, and they don't have a term. They mature when the borrower dies or permanently moves out of the house.
Gotcha. Jeff, do you have anything you want to add?
Yeah, I think one of the things that confuses a lot of people is reverse mortgages they're really just traditional mortgages with a twist, right? You don't have to, it's a mortgage, you still have the security instruments and notes and disclosures. It is a mortgage. But with this particular mortgage, you don't have to make that principal and interest payment, but you actually can. There's a whole segment of potential borrowers that are 62 and older that can afford to make payments, so they only go and get a traditional or a HELOC. They actually would be better served to get a reverse mortgage because they can go ahead and make payments for 2, 3, 4, 5 years while they're still employed before they retire, and then when they retire they can just simply stop making the payment. So when they're making the payments, they will have the benefit of making principal and interest payments, and then when they stop, they can just simply stop making the payments, or they can convert the line of credit that they've been building up into having the lender actually make payments to them. There's the other thing that's a little bit different is the underwriting, right? Because with a traditional mortgage, you're looking mostly at the credit, their ability to make the payment and pay down the mortgage. With a reverse mortgage, because you're not required to make the payments, and most borrowers don't, the underwriting doesn't focus mostly on credit, it focuses mostly on the home, the collateral for that. So that's the biggest difference. But again, there's a huge potential for borrowers that want to make payments, that can make it work like a traditional loan, and then just not make a payment whenever they can't afford to or whenever they want to stop.
Yeah, I think that's an interesting point. Go ahead, Mike.
No, Dustin, I was going to just add that from the investor perspective, and one of the reasons I've been attracted to the industry for so long, because it's all event-based maturities, we don't have a final maturity per se. Yeah. It really allows for very highly predictive cash flow analytics. And this is going down a rabbit hole, but when we did our early securitizations at Lehman Brothers and predicted the prepayment speeds, which includes mortality, of course, over the life of those securitizations, and then look back once those securitizations had been called, we were extremely accurate, down to 1 or 2 loans for each of those bonds and cash flows over time. So it's a very highly predictive cash flow, which really helps from an investor perspective. Plus, the other big difference between this product and the forward market is that for any active loans, in other words, where the borrower is still alive and the loan's not in default, at the time that the loan balance reaches 98% of the value of the property, the loan and the servicing is assigned back to HUD, because HUD has the insurance, HUD takes the risk, and so the logic is that they should manage the end of life for that loan. And so it kind of cuts short the cash flows and kind of helps predict that the final maturity for those cash flows.
Yeah.
Gotcha. So, I mean, from the investor perspective, I mean, continuing on that thought there, Mike, what's the inherent value of reverse mortgage loans and securities in particular?
Well, I mean, it's having an event-based maturity, obviously, as I was just explaining, helps. There's that no extension risk. These loans are positively convex. They have much less prepayment risk. It's not as much an interest rate sensitive mortgage because it's driven by other variables, not just interest rates, primarily proceeds. Although I will say, in fairness to the industry, that has been changing over the last couple of years. And then obviously the spread over other, and the Ginnie Mae guarantee and the Ginnie Mae wrap for the HMBS security, it really makes it somewhat of a unique instrument in the fixed income world.
Jeff, do you have?
I would just add, though, as an HMBS issuer, and the industry does get a bit of a bad rap for high cost to originate. There's some truth to that, but once a loan is originated, the borrower has the ability, obviously, to draw down the remaining line of credit over time. Those future draws can also be securitized in what the industry calls tails, and those tails are effectively issued at par. And so that helps mitigate some of those initial high costs to originate, because all of those subsequent draws are taken out over time, sometimes after 1 year, sometimes over the life of the security or the life of the loan, but they're taken out over time, and that really allows HMBS issuers to kind of average out their overall cost to originate.
Yeah, and that was one of the keys when Ginnie put together this structure, is they recognized that in these loans, typically all the funds aren't drawn up front. So what do you do with all of the future draws, the tails, like Mike said? What do you do with those? And they created this structure that allows you to put initial draws into one security, and then as tails build up, you can actually take those tails and put them into another security instrument. You can even combine them. You can take all of your origination volume that you have, and then look at all of the tails or all of the after closing advances that you've made, and build them into the next security, so that you always have a means, as you're funding loans and borrowers are taking out more funds, you always have a means to securitize those, which means, actually, if you think about it, you could have one loan that is involved with or has pieces of it in multiple different securities. But it was a great design by Ginnie Mae to come up with a way to make this work. So it was huge, and there's a lot of value, in those tails as well. So
correct. And now we've all, Dustin, just to add, we've been talking only about the HMBS, the government program. There is also a segment of the market that is a non-agency, private, proprietary reverse mortgages, and those loans fit well into senior subordinate securities. So very similar performance, other than the fact that there's no assignment mechanism back to HUD, and also event-based maturity. So same concept as before. Very accurately able to manage and model the cash flows and predict outcome returns.
Gotcha. So returning to Ginnie Mae for a second, I mean, is there any significance that Ginnie Mae has got 13 approved HMBS issuers?
The short answer is no. I mean, first of all, the top 5 HMBS issuers account for more than almost 96% of the total HMBS outstanding. So it's a little bit of a misnomer. Those other 8 HMBS issuers are either very small, or some even have portfolios where there's no new originations, and as Jeff was speaking to a minute ago, are just issuing remaining draws from borrowers drawing down their LOCs, so just issuing tails. However, Ginnie Mae, provided that borrowers meet the HMBS issuers can meet the capital requirements and Ginnie Mae's other requirements, I believe as HECM volume increases, that there will be more HMBS issuers over time. So I think in general, there's no problem with having 13.
Yeah, and what the other thing is, as Mike mentioned earlier, that when these loans reach 98%, right, of the home value, they're bought out of the security, which means the lender that is the approved issuer needs to have the funds to buy that back, and then they can turn around and sell it to HUD like they do. But there are some instances where maybe there's a delay before they can sell it to HUD for some reason. So the financial strength of the issuer has to be able to deal with that transaction of, paying it out of the security and then issuing and then turning around and selling it or issuing it to HUD. So.
And I would also add too that while that assignment mechanism works for loans that are active, if a borrower is in default or a borrower has passed away prior to that assignment threshold, those loans are not assigned to HUD. In that case, the HMBS issuer is responsible for managing that loan and the borrower all the way through foreclosure. So HMBS issuance is not without risk.
Gotcha. Well, let's switch gears here for a second. So from the lender perspective, from your point of view, do lenders need specialized secondary marketing staff, resources, or technology in order to sell HECMs and proprietary reverse mortgage loans on the secondary market?
I mean, I would echo Jeff's earlier comment. In many ways, the reverse mortgage market's not that different from what we call the forward market. The loans are originated, they're bundled, there's often an aggregator, they're ultimately wrapped with a Ginnie Mae guarantee, and they're sold into the marketplace. I mean, obviously, proper analytics greatly help understand the inherent value of the loan and the HMBS security. For any large forward mortgage originator who has access to Intex and Bloomberg, I'm sure those tools are available there. Our company, Newview Advisors, has a platform called Evaluator that we use to generate yield tables and discount margin tables. So there are plenty of analytics out there that can be used. But apart from learning the idiosyncrasies of our industry, and there are many, I would say, I think you have to still climb a learning curve around the specifics to our industry. In the final analysis, any entity that's large enough to have a meaningful forward business is going to have the infrastructure in place to be able to become an HMBS issuer and originate reverse mortgages over time. I don't know, Jeff, if you have a different perspective on that.
No, you're correct.
Just a matter of learning new acronyms, huh?
A lot of new terminology. That's exactly right. New acronyms.
Yes, and understanding what the products really are and how they really work, getting rid of those misconceptions of the reverse mortgages. So that helps as well.
Right.
Well, speaking of that, Jeff, I mean, sort of a elephant in the room question here. Why don't more homeowners take out reverse mortgages?
There's a couple of things. One, the industry was really created and designed around helping senior borrowers that are kind of a needs-based, meaning they might not have enough for retirement. They might be struggling to afford their monthly expenses, and they've got this mortgage payment and everything else. So you can use this as a means to help those people that might not be able to qualify for a traditional mortgage because of the income requirements. And that's basically the way it's been sold, and that's how it's built, basically the way that it is today. But like I mentioned earlier, and it's worth saying again, there's a whole market for these and a benefit for these for people that actually can afford to make payments, that can afford or that can qualify for a traditional mortgage or HELOC. If you combine a reverse mortgage as a financial tool in addition to your retirement portfolio, you can do things like draw from your retirement portfolio when it's up, but if the market dips, you leave it alone, and then you can make draws from your reverse mortgage, and you can better time the right place to provide that monthly cash for you. So there's a whole benefit to actually getting the reverse and selling it to people that are 62 that are looking for a traditional mortgage that maybe don't know that this might be a better plan. You can make the payments for as long as you want, so you get all those benefits. And then when things happen, like maybe in December, I want to skip that payment and buy gifts for my grandkids. At some point I'm going to retire, and so I want to cut that out of my monthly cost. They can just stop making payments. The other neat thing about this, instead of a tradition or a HELOC, is it doesn't change the liquidity standpoint of your cash. So when I write a payment to my reverse mortgage, like the adjustable HECM, for example, that money goes and is now available in my line of credit, so I can get it right back if I need to. So I'm not losing liquidity, but still getting the benefits of making the payment and seeing the equity go down and making the interest payment. So there's all kinds of things. It's just completely and totally flexible for borrowers that are 62, that are approaching, or their, life is going to change, in the future. And this mortgage just will simply follow whatever works best for you, and you don't have to refinance in order to, if your situation changed. So there's a huge volume of people 62 and older that are getting traditional mortgages that have not been exposed to or understand reverse mortgages. If new or traditional loan originators kind of understand the benefits of this, then it ends up being a win-win for both lenders and borrowers, right? Because of the value that the mortgage is on the secondary and the value that it is for borrowers. The reverse mortgages are really not right for everyone, but neither are traditional mortgages or HELOCs. So.
Yeah, the one point I would add to that, Jeff, is that if a borrower thinks they may be moving from their house in the short term, in a handful of years, 2, 3, 4 years, that would be a reason to look more carefully at whether it makes sense, only because there are fairly high upfront costs of issuance, including the mortgage insurance premium that HUD requires for its guarantee. So that would be one caveat. But the other answer to your question really is, the industry has suffered from misconceptions for the 21 years that I've been in it. And I think it's just this ongoing education that we all have a responsibility to kind of continue to teach and overcome kind of these misconceptions of the product, including, I will say, there were some early products that had design flaws. And it was 25, even 30 years ago, before my time in the industry. But some of those perceptions still linger.
Yeah, sure. Yeah, it makes sense. But I mean, as a father, 3 of my 4 kids have birthdays in December, so I can absolutely appreciate the flexibility in being able to hold off on a payment in a specific month.
Yeah.
So yeah, let's switch gears here again a little bit and go from the lender's perspective. So some lenders offer proprietary reverse mortgage products. How does that work? What's the maybe the historical experience in this arena, and what should potential investors know?
Well, proprietary reverse mortgages act very much like the HECM, with the exception that because it's self-insured, the LTV is traditionally lower than the HECM LTV curve. They also are event-based maturities, and they really do perform very much the same way, depending on the specifics of the originator. And the securitization market has also been very successful. At Lehman Brothers, as I mentioned at the outset, we did a handful, 5 securitizations during the 5 years or so that we owned Financial Freedom. And we were able to track the performance of all of those securities. It was called the SASCO program. Investors still know that name today. So we were able to track the performance in our capacity at Newview Advisors. And the bonds all performed extremely well. There were absolutely no write-downs, no realized losses on any of those non-agency securitizations, despite the Great Recession of 2008 to 2011. So there's a body of data that was instrumental, frankly, in helping the industry restart the non-agency product post the Great Recession in 2012, 13, and 14. My business partner, Joe Kelly, while we were at Lehman Brothers, designed almost all of the products that were in the marketplace in the late 90s and early 2000s. And so we've been able to track all of that data and use that skill set to reintroduce the non-agency products that are in the market today.
Mike and his team were pretty much the pioneers in this space, and put together with Joe the first reverse mortgage securitization.
Right. So, yep. And the key, frankly, was that the rating agencies, it was a new asset class for the rating agencies. They wanted to be conservative, and they built in a 30+% drop in home price appreciation at time 0. So we were able to withstand that exact scenario when it happened in 2008, 9, 10, 11. And because of that, we're very proud of the performance of those securities. Today, there was this transaction that just priced last week. Since 2017, give or take, there've probably been about 25 securitizations, which I know these are all small numbers for the forward industry, but for our industry, it really represents dramatic growth and very exciting future for kind of a more even blend of non-agency and agency product over time. So it's been a very good story for us.
Yeah, it sounds like there's, I mean, again, you both mentioned the opportunity out there, and it seems like, yeah, I mean, if you're, compared to the forward industry, there certainly is room to grow, but I mean, that's where their growth is going to be. I mean, everyone's seen the numbers from the MBA. I mean, origination numbers are certainly going to be lower this year and likely lower next year than they were in 2020 when everyone had a great year. So maybe looking forward here in the next 6 to 12 months, what's on the horizon for the side of the industry?
Well, I mean, first I'd say the pandemic was probably a net positive for our industry.
Yeah.
For those borrowers sitting on the fence trying to decide between aging in place and moving to a nursing home, which is obviously a very logical decision later in life, that was taken off the table with the nursing home struggling to contain the coronavirus and the more immediate need to access equity in their homes for emergencies like the pandemic. It really has put our industry back on the map and the product, I think, in a much better place for growth. Along with the pandemic, as this audience knows well, the precipitous fall in interest rates, never mind the rising home values that we've been watching, has allowed borrowers to take out and get more proceeds from the product. So we're in a very positive reinforcement loop right now with the product, and we're seeing, frankly, record volume, at least from an HMBS perspective. Our previous record, well, last year we hit 10.6 billion, again, small by forward industry standard, but for us, a record. We're on track today to issue $12 billion for our industry. So we're seeing some reasonable growth.
Yeah, and I'm going to jump back 1 second to the proprietary reverse mortgage. One thing to think about there is the HECM has its lending limit, a little over 800,000, and we'll only look at home values of that or less. The proprietaries don't have that same limitation, right? So they can look at the areas of the country that have typical homes that are greater than that, $1 million, $2 million, that type of thing. So that gives opportunities with people with the larger home values to have an option as well, in addition to the HECM.
Yeah,
Plus,
well, I mean,
right, and it's not just a jumbo market, Dustin.
No, not at all.
A borrower that, let's say, only has a specific need that doesn't want to have to pay the upfront mortgage insurance premium that HUD requires for the home value, but only needs to take out a certain amount, then a HECM might not make sense. So it's not only about home size and home value. It really can be specific. There are also condo projects that may not qualify for HUD that are eligible for non-agency. So there are a number of scenarios. That's why we don't like to call it a jumbo program. We really prefer calling it proprietary because there are a number of needs away from HECM that it satisfies.
Yeah, and they've designed proprietary reverse mortgages that have line of credit options that are available. They don't work quite the same as the HECMs, but or a monthly payment option. So they give you some of those similar options that you can get with the HECMs too as well.
Yeah, we were before the pandemic. Our industry was excited. We're January of 2020. The talk of the town was 2020 was going to be the year when dollar volume non-agency exceeded HECM volume for the first time. That was really what we were expecting during the course of 2020. So pandemic slowed that progress down, but we're seeing good volume back now, as I mentioned earlier. I think lenders are excited that that market has returned, and we expect to see several more securitizations in the summer and fall.
Yeah, makes sense. And again, I think it goes back to, you guys touched on it, but the flexibility. I mean, everyone's situation is different. I mean, whether you're in a home where you're in an area. I mean, the area where I live in, I mean, the home values have just gone through the roof, and so people who had a $500,000 house and would have qualified under the Ginnie program, now, I mean, their house may be $800,000 or $900,000, and now they're, now that the proprietary programs would be perfect for them. But I mean, they wouldn't have considered themselves. They're not living in Malibu or something like that, where it's traditionally high home value area.
Very true.
Yep.
Yeah. So let's close out here. We got time for one more question here before we head out. But so just looking at the advocacy work of organizations like the California MBA, the MBA, and the National Reverse Mortgage Lenders Association, why is it crucial for lenders to support the work of those groups?
Well, I mean, I think supporting trade associations as educational resources and policy advocates and public affairs centers is integral to any successful industry. Like with Jeff, I'm on the NRMLA board and the executive committee. And I know for a fact our industry could not exist without a group such as NRMLA and the MBA. It's critical. I mean, we have to centralize relationships with HUD and FHA, Ginnie Mae. We're lobbying Congress. We're managing various legislative bodies, consumer advocacy groups. There are legal and state legislative issues that arise that we need to manage. Never mind the traditional educational and marketing events and the conferences. And it's a single voice for the industry, and all of those facts lead up to making it critical for the success, certainly of the reverse mortgage industry, and I'm sure all industries.
Yeah, it's the education perspective of them, you know, from what we've done at the National Reverse Mortgage Lenders Association, is not just trying to figure out better ways to educate homeowners, but how do you educate the financial planner community? How do you educate new people as they come on board in Congress and they don't really understand reverse mortgages? So there's a whole huge component of education with that these trade associations do and help with to make sure that people are educated and get rid of those misconceptions of the reverse mortgages and can better understand them. So they're absolutely, as Mike said, critical to the business, to keeping Congress and everything aware of what's going on, and to continue to provide this benefit to seniors.
Yeah, no, I think that's a great point, Jeff. I mean, even, you know, in California or in DC, I mean, you have a lot of lawmakers and policymakers who don't even have a good understanding of how the forward business works, much less the reverse.
That's correct. Yeah.
But yeah, I think the education is even more crucial than, and I mean, I wouldn't have said, I've never said this to another guest, but you know, the education is even more important in your particular sector of the industry than, you know, just the traditional mortgage market. So you guys have certainly got your work cut out for you at the National Reverse Mortgage Lenders Association.
We do.
Yep.
Yeah. So Mike, Jeff, thanks again for joining us here on Connect. It's been great to chat with you guys. There's a lot of good content and education for our industry here. And so thanks again for joining us.
Thank you for the opportunity.
Absolutely. Yeah. Thank you very much.
Got it. And so if you enjoyed the conversation, make sure and subscribe to us here on our YouTube channel. You can also find us on Spotify, on SoundCloud, and Apple Podcasts. And make sure the Western Secondary market registration opens tomorrow. So go to westernsecondary.com, bookmark the site, head over there tomorrow, and registration will be open. Otherwise, we will see you next week on Monday morning for another episode of Connect. We'll see you then.